Well, good afternoon, everybody. Welcome to today's live event brought to you by IBKR Webinars. A huge welcome. And today's event is coming to you from Sheridan Options Mentoring, and I'm delighted to have with me, as we do every month, Dan Sheridan. How are you, Dan?
Oh, I'm doing good, Andrew. Hello, everybody. Glad to be here on this nice day today, depending on where you live. Yeah.
Well, I'm up in New York State today, and we've got snow coming down. And I guess how is it for you over there, Dan?
It's a little warmer. I'm in the South, so it's a little warmer, but yeah, no snow right now. And yeah, I know New York gets cold like Chicago, doesn't it?
Yeah, not quite as cold, but it certainly has the potential. So
Yeah.
so it's a nicer day. Here we are, early March, and the whole Ukraine crisis continues to play out. The investors are a little bit, so there's a risk on field today. What's actually happening out there at this moment?
Well, I think today you're just, in particular today you're just getting a little bit of a swing up here, right? Which is normal in this type of market. But I think, the dynamics in the market right now, Andrew, you've had this correction that started January 4th, and we're still into this. People aren't used to, after, being in a bull market the last 8-9 years, and people are just used to the market going up. And then they have a little over 2 months here where it's like bad weather, and people aren't used to that, right? And now you throw on the Russian stuff, and it's kind of keeping the market kind of in this down area. But like over the last 5-6 days, we've had a bit of a range, even though it's been, pretty wide. So I think for a lot of people, just patience, because they're used to, right? Market goes up, or if we go down, we'll go down 1 or 2% in the SPX, and then it's off to the races again. So I think this is I think really it's an adjustment for people, right? That you're spoiled, right? Market's going up. It'll go up and it'll go up and, go down a little bit and then it'll go up. And so this is a different market than people are used. People aren't used to being in an environment where VIX is over 30, right? And what do you do? How do you, so it's a different environment. And also, I think the biggest thing for new traders or beginning traders is execution. When the market is moving around pretty fast, execution's a little more difficult, right? To get maybe a decent price. So, it's a good learning experience for people. Most people, I'm sure most Interactive Broker customers, I know I can say this confidently, they haven't had much experience on the downside. And you say, Dan, how do you know? Well, bring up a chart, right? We haven't been down that much, right? So this is, I think you be patient. I think, keep a good attitude, folks, for learning, trade a little bit smaller, but I still think there's some opportunities, but it's getting used to, it's like, if Andrew, one last comment, but, in Chicago, the first snow of the year in December, everybody makes a big yahoo about it and be careful driving. By March, by now, after about 15-20 snows, nobody cares, right? It doesn't, if it was 15 inches, it wouldn't affect if you wanted to go to the movies or you wanted to go to a restaurant, you go, right? You're used to it. And I think the longer we've been 2 months in this kind of winter weather storm in the market, and I think you just got to get used to it. That's all it is. I mean, it is a little concerning when you're, Russia, the evil empire, as we say it, and you think all the implications. But, remember, a lot of this is discounted in the market. So I think right now we've actually been range bound over the, I think for range bound trades, believe it or not, over the last 2 weeks or so have not been bad, right? Because of the high premiums you're getting, you can handle these kind of 70, 80 point moves a little better than when the volatility is lower. So as my Irish grandmother would say, to make a long story short, I definitely didn't do that, but that's my 2 cents.
Well, that brings us on nicely to the subject of today's event, Condors for weekly income. So tell us about what we're going to learn here today, Dan.
Yeah, I think since the advent of weeklies, I don't know if it was 7 years ago or whatever, when we were trading in the pit many years ago at the CBOE, expiration, you could only trade expiration week, the last 7 days once a month. Now, with this advent of every week is expiration, right? Every week you have options that have 7 days to go. And what's happened the last 2-3 years, every Monday, Wednesday, and Friday, you have options expiring. So, today is Wednesday. In the morning today, you could have put on a trade and it expires at the end of the day. Friday, you could put on a trade in the morning, it expires at the end of the day. Monday, you could put a trade on in the morning, it expires at the end of the day. You could do that 3 times a week. So these one-day trades, which a lot of people like myself who have a personality, they like a little bit of action, right? And they're maybe don't have the patience. I think these trades, like anything in life, has the pluses and minuses. So I'm trying to give a little bit of a balanced thesis of this trade, which I think is a very good trade, like anything in life. You ready for the next comment? It's a very good trade if you know what you're doing, right? Isn't that great? So hopefully we'll bring you in the ballpark a little bit on this trade, and I'll give you my 2 cents on it, everybody, for whatever that's worth. Hopefully it's worth at least 2 cents today.
Very good. All right. I'm going to make sure, Dan, that you can see the questions as they come in. Folks, it's a live event being recorded. You'll receive a link a couple of hours after Dan's wrapped up today. So, Dan, you might lose audio for 1 second. Just bear with me.
Okay.
And I'm going to put this onto the second screen to look at the disclosures, folks, talking about options here, potentially risky products. And as Dan just reiterated, this stuff is good if you know what you're doing. So that's what we're here to learn today. Just make a point of understanding the disclosures, and that you have seen that document, the characteristics and risks of standardized options. You've all acknowledged that during the registration process. So Dan, I'm going to put this onto screen page 3 for you.
Thank you, Andrew.
Do we know this guy?
Yeah, for many years ago. Yeah, it's always, as I always say, it's good to have if you're ever doing a webinar, have a picture of yourself at least 25 years in the past, and you'll be in good shape. So, but thank you, Andrew, for that. And folks, let's get started. And you know what? Feel free if you have any questions. I think I have my question thing up here. You can ask a question. If I miss it, Andrew will probably let me know. And this is for educational purposes today. So don't run out and do this, especially if you don't know what you're doing or have any experience. All right, well, let's jump in here, Andrew, if that's okay. And so here's some general comments, then I'll bring up a slide. I'm just trying to give you a little bit of a feel for this type of trade, and the good, as Clint Eastwood would say, the good, the bad, and the ugly. So we're going to talk about a one-day iron condor trade. As I said, these types of you have one-day option every Monday, Wednesday, and Friday. There's options that expire, and I'll get into a little bit the logistics of this one-day trade. But I want to focus for now on what is the strategy that we're going to implement for this one-day trade, right? It's called an iron condor. I don't know I still don't know to this day how they got the name Iron Condor. I know there was a rock group in the 70s, maybe 80s, called Iron Maiden. Some of you may remember. I'm not a hard rocker like that, but that's what I always think of. So Iron Condor is we would call it a high probability trade. It's simply doing a call credit spread out of the money and a put credit spread out of the money at the same time. So you're bringing in 2 credits, and as long as the market doesn't move too far one way or the other, you collect your credit. So if you want to just give a visual, right? If you guys can put on your visual memory right now, if the stock is at 100, I would sell a 110 call, and then for protection buy a 120 call and bring in a credit for that. And as long as we don't go through 110, I collect the credit. And then on the downside, again, if XYZ is at 100, I'll sell a 90 put and buy an 80 put. That's an put credit spread. So I'm doing one on the put side out of the money, one on the call side out of the money. The probabilities are that it's not going to go through these short strikes at expiration, and you would collect the credit. That's the simple form of what it is. We haven't got into risk management. Ann says, I think iron condor, I think it is after a bird, condor that has wings. Okay, that makes sense. Yeah, thank you. Thank you, Ann. Now, why do an iron condor? I would do an iron condor if I felt we were in some type of a range in the market, and I wanted to put on a high probability type trade. And what I mean by that, the next point, probabilities of this trade. For example, on this trade, and I'm going to show an example in a second. I'm just going to throw words at you, but it'll make more sense when you see a picture. But how many, the way I pick the short strikes in an iron condor, I may sell a out of the money call. So I may pick my call side by maybe selling a 10 delta. How many of you understand what that means? If I say, hey, I'm going to pick my short strike to sell this out of the money call, and I'm going to sell a 10 delta for the call that I sell in an iron condor. Yes or no? Do you understand what I just said? Yes or no? Dan, I understand what you just said. So it's just saying, I pick my short strike. I pick the strike I'm going to sell by the delta. So if I sell a 10 delta call, so if XYZ is at 100 and a 10 delta call is, let's say, 115, and I sell that a 10 delta call is, let's say, 115 with XYZ at 100, what it means is there's only a 15% probability we're going to close through that short strike at expiration, which means an 85% probability it's not going to close through that short strike. So when I'm selling something way out of the money, I pick the short strike with a certain delta, right? So in this particular, I'm not presenting a chart right now. Right now, I'm just talking. We have one slide up. I'm talking through just a few general things on this type of trade, and then we're going to look at a pretty picture. The delta figure is just, you just get that on your brokerage platform. It'll give you, it's just a metric on there. And so it's a high probability trade, but again, to me, the most important thing I just said there is, do you need, do you want to do this in a trending market or some type of a range? What's the answer? Would you rather do this in a trending market or some type of a range? Now, believe it or not, right? I know you guys won't believe this, but if you guys look at a price chart of SPX over the last few weeks, even though it's moved a bit, it's in a range, right? The 10% correction that we've had in the market that started January 4th, we kind of corrected, but the last month or so, or 3 weeks, whatever, it's been a range, a big range, right? But a range. So you like a range. Now, Sam says, Dan, why the 10% delta, not the 20%? Well, all right, so let me explain something on how I structure this trade. And I'm dealing with a vehicle. I'll combine these, this slide with the different ones. I'll just start talking about some of them. I like SPX as a vehicle, right? Or SPY instead of a stock, right? The reason, let's go backwards. The reason I pick SPX is it's a well-diversified vehicle of 500 stocks. It's a relatively low volatility index, and I don't have any stock specific risk, right? If I did an iron condor on a stock, anything can happen, but I'm in a well-diversified vehicle. So SPX or SPY is 10 times smaller. SPX generally is the vehicle I use, right? Does that make sense? Why I use that versus a stock? Yes, no? Do you understand why I use SPX versus a stock? And I'm not saying you can't do it with a stock, right? I'm not saying you can't do it with a stock. I'm just saying it makes more sense to me to do it's less volatile, as Trevor said, and it's a well-diversified vehicle. Makes sense to me. Now, duration of this trade, we're talking about one-day trades. And back to Delta for a second. So if we're setting up a probability trade, here's my dilemma. My dilemma is I want to go far enough out of the money, but if we go too far out of the money, right, we're not going to get any money, right? We're not going to, I don't want to go so far out of the money that my probabilities are very high, but I'm not, I'm getting 30 cents. The yields will go down. So I try to go somewhere between a 10 and 20. What I do on these weekly trades, I try to set this trade up a little more equidistant. What do you mean by equidistant? I want my call side and put side, it doesn't have to be equal, but if the stock's at 100, I'd sell a 120 call, 20 points up, and an 80 put, 20 points down. Now, that would be equidistant, right? Now, what's the foundation of an iron condor? Do you guys know, and ladies know? What's the anybody know why do I do this trade? The foundation of an iron condor is selling an out of the money call and an out of the money put. And then I'm just buying my hedges along further out of the money. But do you know what that's called? An option parlance. If I sell an out of the money call and an out of the money put, does anybody know what do you call that strategy? That's the foundation of an iron condor. Do you know what that's called? Any of you? The foundation of the trade I'm talking about today. Selling an out of the money call, out of the money put. So we get probabilities. And anybody know what that is? Yes, no? Oh, I'm sorry, I didn't scroll down. Sorry about that. It's a strangle, right? Selling an out of the money put, out of the money call. Now, that's really like an insurance company. That's all I want to do is sell an out of the money put and out of the money call. Way out of the money, probabilities are in my favor, they'll expire worthless. And I'm selling, let's say I sell an option at, $2 on the call, $2 in the puts. Every day they'll decay. If I do it 30 days from expiration, most times I just collect my money. What's the problem with that is if I just sell a naked call and put, will interactive brokers be happy with me? Yes or no? Not that they will be happy or sad, but my point is, if I sell an out of the money put and out of the money call, will they ask me to put up quite a bit of capital because of the risk associated with selling uncovered options? Yes or no? Will they make me put up an awful lot of capital to sell an out of the money put and out of the money call without a long against it? Yes or no? Yes or no? Yeah, a boatload, right? So if I have to put up a lot of capital, what's going to suffer? What's going to suffer? My yield, right? So I buy the hedges, right? I'm going to have a much better yield. So we'll look at an example on it. SPY is a good vehicle for this type of trade. And for how many of you are beginners? How many of you are beginners in the options, learning options? How many of you are beginners? I would recommend playing with something like SPY, SPY, or something. It's, you say why? It's 10 times cheaper than SPX, right? Now, SPX, I'll show you how you could do it cheaper in there also. But anyways, this is a high probability trade, and I'll get into when we have a picture. Andrew, let's go to the next page. I think with a picture, So this is a picture of what we're doing, right? So let's set the scenario, right? Let's set the scenario. So the scenario is this. Every Monday, why is this one-day trade? What do I like about this trade and what do I not like about this trade? Well, what I like about this trade is, so I'm drawing you a picture and I'll get into the logistics in a second, but the idea is every Monday, Wednesday, and Friday in the morning, the market opens. I let it digest for maybe a half hour and then I put a trade on. So there's no overnight risk. There's no gap risk, right? If I do it like this. In other words, market opens, half hour after the market opens, I put this trade on, and 3 or 4 hours later, I take it off, right? And I'll give you some more logistics. Does everybody understand that part of it? At least what I'm saying. You would put it on Monday morning after the market opens, maybe after a half hour, take it off early afternoon. You do that Monday, Wednesday, and Friday, right? That's kind of a basic thought. We'll get into more. Do you understand that? When I would put it on? Yes, no? Right? So all I'm talking about, Lindsay, is when I would do this trade, right? So the biggest thing I like about this trade is, for a one-day trade, is I'm putting it on after the market opens. But here's the other thing. If the market, with this type of a trade, it's more range bound, right? The market stays in a particular range. So today, right, was a Wednesday, correct? Today's a Wednesday. Did the market open up a lot today? Yes or no? Did the market open a lot today? Open up a lot? Yes or no? Did the market open up a lot today? Yeah. So I look at the market, it's up huge. After a half hour, under the laws of the Geneva Convention, the Illinois State Constitution, can I determine that this probably isn't a great day for a range-bound trade, and I can say, I won't do one today? Am I allowed to do that? Yes or no? Am I allowed to, if the weather conditions don't look good, and I'll explain that in a second, can I not trade? Do I have to trade every Monday, Wednesday, and Friday? No. That's the beauty of it, right? There's no overnight risk, right? I can choose when I want to play. So what am I looking for? I'm looking for, after that first half hour, here's some things going through my mind. You know, no big news day, no Fed announcement coming out, but I'm looking maybe, you know, that SPX, right, at the opening, or the, you know, that after that first half hour, isn't up or down more than 1%, right? I'm just looking for that day not to be, for that day to be relatively under control. I don't know what's going to happen once I put it on, but like on a day like today, I'm not sure I would put one on because we had a big move right at the opening. I can back off, right? That's the nice thing about it. You don't have to play every day. Now, I'll get into risk management and everything. So let's just go through an example. So if you can look at here, XYZ Iron Condor, I sell a 467 call, I buy a 477 call. Does everybody understand that that's called a call credit spread, that part of it? The 467s are out of the money. The price on this slide of XYZ is 437.05. So everybody see I'm selling something 30 points out of the money. That's called a call credit spread. Or most of you understand what that is. So you receive a credit and you receive the entire credit on that, the call side, as long as we don't close over 467 at expiration. So does everybody understand what that is? And then the put side, with in the red on this XYZ at 437, we're selling the 404 put, about 33 points out of the money. And we're buying the 394 puts. So this is these are two credit spreads. The combined credit is $2.10. And as Andrew is showing, we make money between 404 and 467, right? And the green graph is the expiration graph. Just focus on that. That's what the graph looks like in 30 or excuse me, at the end of the day. So you can see if we go beyond 467, we start losing money, but it's a defined risk spread, right? Where Andrew, that hockey stick kind of looked to it. And because you have a long call against it, 10 points away. Now your risk on something like this, the way you do the risk and all that kind of fun stuff is, and we'll get into this, let me go through this and then I'll answer all the questions, but the difference between the short strike and the long strike is 10 points. The difference between the short put and the long put is 10 points. The distance between the short call and the long call is 10 points. So your risk, because there's 10 points difference, is $1,000, 1,000 less the credit of 210. So my margin or risk or capital I put up at a brokerage firm is $790. So if I'm bringing in a credit of 210 or $210 divided by 790, yeah, this is like a potential 20-25% return. Do you guys see that? As far as the credit, the risk. So again, you're selling it for a credit. Now, is bringing in a credit of $210 to risk almost $800, is this a good risk reward? Is this a good risk reward? To bring in 200 and some dollars, 210 credit to risk almost 800. Is that a good risk reward? Yes or no? Yes or no? Risk reward, I would say no, right? Right? If I'm bringing in $200 credit and my risk, if it goes against me, is 800, do you see that? I can only make 200, but I could only make 200, but I could risk 800. Does everybody see how that's not a good risk reward? Yes, no? That is not a good risk reward, right? Right? I can make 200, right? But if it goes against me, I could lose 800. So if 3 trades in a row, I make 200, make 200, make 200. And if one trade I lose 800, does it wipe out my winners? Yes or no? So risk reward, it's not so good. Now, here's the big question. Does risk reward make it a good or bad trade? Do you think so? Does the risk reward of the trade make it a good or bad trade? Does the risk reward make it a good or bad trade? I would say no. What makes a trade good or bad? Well, risk reward could play a factor, but the point is, it's the person behind it. It's the person with the steering wheel, right? It's the risk management, right? How do you manage it? And if I'm making, so a simple guideline is this, ready? What I'm going to tell you in a second, whether you understand Vega, Greeks, options, you'll all understand what I'm going to say next. The most important thing for this type of trade. Are you ready? Ready? What I'm going to tell you is the most important thing concerning this trade, right? Two most important things. And not one of you are going to be able to tell me I don't understand it, because it has nothing to do with options, right? If you said to me, to be successful, I'll give you three things. What's the three most important things to be successful at this trade? And if you are diligent with these three things, you do very well with this trade. It has nothing to do with options. Not one of you can say, well, I don't get, you'll get it, right? You'll get it. Number one, consistency. If you're going to do, well, consistency. If you're going to do, if you were a blackjack dealer in Vegas, the point is, if you have probabilities in your favor, do you need to play quite a bit, right? So number one, consistency, right? Consistency. Number two, so you need to play. Now, does it mean you got to play every Monday, Wednesday, and Friday? I think I've already mentioned that. No. If you get a crazy day like today, you can stay out. You might play once a week, you might play twice a week, whatever. But unless you have a big move for that day, right? If you, to me, after the first half hour, as long as SPX hasn't moved more than 1%, I'm usually in, right? If there's no big news day. So number one, consistency. Number two, you ready for this one? Number two, don't lose more than you make. How's that one? Is that deep? How many think that's a deep thought, right? If I'm trying to make, like, for example, if the credit in this example is 210, let's say I'm trying to make half my credit, and let's round it to $1. Are you guys with me? I'm trying to make half my credit. You with me? That's a good, that's a basic guideline. So if I'm making half my credit, and let's round about $1, does everybody see that? So if I'm going to do, and let's just say over a year, I'm giving you the big picture perspective. I'm going to do this trade. Let's just say it's even twice a week for the next 50 weeks. How many trades is that? Twice a week for the next 50 weeks. How many trades am I going to put on? Twice a week, the next 50 weeks. That's 100, right? 2 times a week. Let's say I don't trade today, Wednesday, but I traded Monday and I'm going to trade Friday. 2 times 50, 100. 100 trades. And if 100 trades, I'm making out of 100, I'm guessing I'll probably win 85 of them, right? I'm just guessing. 85, I win $100. Does everybody understand how important it is to keep your losers under control? So if I'm making 100 and I don't lose more than, let's say, 120 or 125 at the most, does everybody see at the end of the year how that would be a very good business? Keep your losers under control, play consistently, right? Don't play, if the market's made a big move in the morning. Is this starting to make sense a little bit? What don't you get? Carolina, what bothers you so far? Or give me an idea of what you don't get. So if I'm making half the credit in this example, $100, right? That's $100. What's divided by 790? What kind of yield is that in this case? If I made $100 divided by 790, what is that yield wise? What is that yield wise? Is 100 divided by 790, is that good yield or bad? Is that going to be over 10%? Yeah, 12% or whatever. So what expiration would I do? Monday. So today is March 9th. So after the first half hour today, if I was going to trade, what expiration would I do? If I was going to put this on today after the first half hour, what expiration would I do? What expiration is it? It's today, March 9th. And if I go Friday, right? If I go Friday after the first half hour, what's the expiration I'm going to play? March 11th, right? So the expiration I'm going to play, right, is today, right? So when I go on Friday, Friday's March 11th. Does everybody understand I'm going to play March 11th? Yes or no? If I go in Friday, I'm going to play March 11th. Do you understand? Yes or no? Yes, no, maybe so. All right. So now here's the thing. If I put it on, market opens at 8:30 Central, 9:30 Eastern. Let's say I put it on within a half hour. I'm looking for on the trade. So here's again, we can't cover everything in one day, but the point is, let's say I'm looking for 10%, right? 10% of my risk, right? Does everybody understand how I get my risk or margin? All I'm looking to do is make 10% on my risk or margin. So I'm looking to be out of this trade by early afternoon. Am I holding this to expiration? No. Am I going to get assigned? No. Do I hold it till the end of the day? No, 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 no. I'll be out of this by the last hour, right? What if I don't get out of it? You'll get out of it, right? You have to get out of it, right? Get out of it, right? So all it is, does everybody understand? If I say I want to make 10%, how many understand what those words I just said? I'm making 10%. It's not 10% of the credit, it's 10% of the risk. In this example, the margin or risk is 790. How did I get that? The width of the credit spread is 10. It's $1,000 of risk less the 210. I have $790 of risk or margin. That's what I put up at my brokerage firm. So if I'm trying to make 10%, it's not 10% of the credit, it's 10% of my margin or risk, which is about $800. So I'm trying to make $80. So if you sell something for $2.10 credit, and I want to make $80, where would I buy it back in the afternoon? If you sell it for $2.10 credit and you're trying to make $80, where would you buy it back in the early afternoon? $2.10 from 80 would be $1.30, and that's it, right? Now, what human virtue or characteristic is going to be the most important thing for Brad or Anil or Michael or Ann to be successful at this? What do you think it is? What human characteristic or virtue is going to be, from what I said on this trade, to be absolutely essential. Patience, but discipline. Discipline, right? It's all discipline, right? Right? It's an easy plan. Trying to make 10%, right? If I sell it at 210, I'm trying to make 80 bucks. I buy it back at $1.30. And usually what I would do if I'm trying to make 10%, I might have a 15% max loss, right? To let the probabilities work, give myself a little bit of room extra. So 15% of 800 would be about how much? I'm just rounding it 790 to 800. Approximately, without a calculator, what's 15% of 800? Without a calculator, don't cheat. What's 15% of 800? 120. So if I sell this for 210 credit, at what point will I close this thing down faster than you can say potato chips with dip? I don't want to lose, if I'm making 100 and I don't want to lose more than 120, when that credit gets to what point do I say, see you later, alligator? If it hits 330 and you don't get out, we're taking away your option keys for 1 month. Does everybody understand that? It's a discipline. Now, let me ask you another thing, right? So 15% loss, right? If I don't want to lose more than 15%, I take the margin of risk is 790. I just rounded it to 800 because I can do math better on 800 than 790 in my head. 800 times 15% is around 120. All right, 120 plus that credit. If it hits 330, I'd get out, right? Now, here's also what I would do. For a profit, I always have an order in to get out. If I sell it for 210, make 10%, buy it at 130. For the loss, I'm only attacking the bad side. Dan, what do you mean? What do you mean? I don't always get out of the whole iron condor. If the market goes south and goes down, when the iron condor is trading at, like we said, 330 or whatever the level, 330, I would just take off the bad side. Does that make sense? Call side's not going to be a problem, mostly. I mean, that's what I do. You could take the whole thing off, but I would just take off the bad side. Save you a little bit of commission also. You could set it up for OCO. I'm just trying to give you, with the time we have today, I'm just trying to paint a picture. And then I'd encourage you to paper trade this for a couple of weeks. Just get used to it. Get used to the rhythm of it. Lindsay says, can you give the timeline of the day? Yeah, the timeline of the day, Lindsay, would be, half hour after the market opens, I take a look. As long as there's no big news day, there's no big announcement coming out, SPX hasn't moved more than 1%, it looks, relatively under control. I'd go out and sell I'd go in, so let's pretend it's today, right? I'd come in after the market, half hour after it opened. Is it moved up or down 1%? Well, today it did, but I'm just using today as an example. I'd sell a 10 delta call in SPX. And if you're a beginner, right? So if let's say you've been trading a little bit, I'd sell a 10 delta call, right? Buy my out of the money call 10 points higher. Go sell it, 18 or 20, close to a 20 delta put. Buy my protection 10 points further out of the money. If I'm a beginner, I would do 5 points between my short and my long. Then those trades, you're typically getting maybe 75, 80 cent credit. You might have $420 of risk. So if you're a smaller trader, if you do 5 wide, it's going to be about $420. If you're 10 wide, it would be, closer to 850. If you did 20 wide, it's going to be 1,500 or whatever. The point is, the smaller the trader, the narrower the distance between the short and the long strikes, right? Now, Dennis made a good point. And I don't know, Andrew maybe could address this. I think if you're going to do this on a regular basis, you're getting in and out of the trade in one day. So I think you have to have 25,000 in your account to do this. Is that right, Andrew? Because they get you with that day trading rule? I'm not sure if
that. I can't remember the answer to that one, Dan. I know it's come up before and I should know.
Yeah, I think there's something with that because they kind of flag you as a day trader if you're getting in and out the same day. But if you have 25,000 in margin, not that you're trading 25,000, you get me? So if you have $25,000 in that account, then they don't flag you. And all it means flag, I mean, they won't let you do a bunch of those trades. Like if you do, they'll stop you for a day or two. But if you have 25,000 in, now, if you do this trade, you can do it for 500 bucks. So you don't have to use I wouldn't use the 25,000. You could literally trade 500 of it, but you'd have to have that in there, you know, but maybe they would let you, I'm sure you could put it in something bearing interest or put it in an ETF or something, but you have to have 25,000. I would check into that. I think Andrew could do the stop loss. I mean, here's the other thing. Andrew maybe could direct you how to set a stop loss in Interactive Brokers. And this is some of the logistics of it. But I would just, again, I just wanted to, we could spend a couple hours on this today, but I think I'm just trying to paint a picture for you. And I hope I did of this trade. I think it's a very good trade, right? I think it's a very good trade, but again, it's, you know, is it for everybody, right? If you're, you know, if you're working all day and you can't look at all, right, you'd have to get in the rhythm of having an order in, right? It'd be ideal if you can, you know, look at it once in a while, right? Because it is a little more time consuming, but I think it's a very good yield trade. Anyways, Andrew, why don't we go to the next slide? Because we're running out of time. And I just wanted to, again, I'm just trying to paint a picture. So when to put it on, you put it on after the first half hour, Monday, Wednesday, Friday. Again, you know, again, there's flexibility here. If you just want to do once a week, if Wednesday you're off from work, do Wednesday. You know, if it's relatively quiet, what strikes to sell and buy in SPX? If you're, you know, you sell around a 10 delta call, somewhere between a 15 close to 20 delta put. Again, I'm trying to get equal, you know, roughly equidistance from where the SPX is when you put it on to the shorts. Ideal duration, you know, you're just doing one day. Now some people just, you know, some people will, hey, it's Wednesday expiration. Instead of putting it on Wednesday morning, they'll put it on Tuesday and try to get out of it Tuesday, or put it on Tuesday for the Wednesday expiration and try to get out of it on Tuesday or something like that. And I think that's fine too. I just don't like going overnight to take that weekend risk in a short-term trade. VIX considerations. I'm not going to give you VIX considerations. I don't know if I would give that. I would just say more, I'm more concerned there's some type of range going on. I'm just trying to give you some basic stuff here. Market conditions most suitable, some type of range. But again, when I'm looking at the market, I'm not looking at the last year. I'm not looking at the last 6 months. I'm not looking at the 3 months. What matters to me is the last couple of weeks. Profit target's about 10%, max loss 15%. execution tips. I'd only get out of the bad side, but I think this is enough to get you going to paper trade it. I'd be happy to sit here, answer any questions. One question, would you close only one side of the Condor when I'm getting out for a loss? Yes. But, you know, if I do the trade, let's give you an example. Let's say I do the trade for $2 and $2 credit, or $1.50 credit would be more likely after the half hour's open, right? Immediately after I sell the order for, you know, $1.50, I'm going to put an order in, you know, an order to buy it back. You know, if I sell it for $2, buy it back at $1 or whatever, and it's going to be in there immediately, right? So I'll always put my order in to get out for a profit right away. Depending on your work schedule, whether you could watch it or not, you know, if it moves against you, you're just taking off the bad side. Remember, again, losing isn't a problem. We're looking at winning a lot more than we lose. It just is. How many of you remember the famous Barney Fife from Andy Mayberry? What did Barney Fife from Andy Mayberry, what was his famous saying? Do you remember? Remember from Barney Fife? Andy Mayberry, remember the TV show? Nip it, nip it, nip it in the bud, right? So what I'm saying is I don't play a lot of games with this, right? If it's going against me, close it. Live to play another day, right? This is a probability game. I plan on doing 100 of these in a year. If I win on 85, I lose on 15, but I don't lose much more than I make. It's going to be a good year. So anyway, I just wanted to introduce you guys to that type of a trade. Again, please paper trade this. Understand what in the world you're doing here. You can do this on SPY. I'm pretty sure. I haven't done it on SPY. I've done it on SPX, but I would imagine you could do it. Why couldn't you do it on there? Yeah, I would think.
I guess, you know, look for the weekly options, right?
Yes.
When you trade a workstation or
oh, yeah, I see what you're saying. Yeah, no, you're right. Whoever said that, you're right, Robin. Yeah, I don't think that SPY doesn't have that Monday, Wednesday, Friday expiration, correct? I don't think. Maybe they do.
Right. I think it's weekly and it's Friday, right?
Thank you, Robin. Yes. Yeah. So SPX is, again, if you're beginner, just do 5 wide spreads in SPX, and that would be generally about a $450 trade. You do 1 contract. So your risk is, if the world ends, is $450 or 5, you know, 4 to 4, somewhere in near $400. But again, I heavily recommend, and I say this heavily with the word heavily, paper trade this. Get it in your bloodstream. Watch it. But again, is it clear to everybody we don't want to do this on a, you know, it's like if I say to Andrew, you're taking your kids, you're going to go by the ocean for a week swimming, but every morning, right? His wife says, Andrew, should we go to the water today? You know, the waves look 8 feet. It's raining. Today might be a good day to go to the museum, right? I mean, we're still using our head here, right? But again, I like the fact that we don't have to deal with overnight and that gap risk. So that's what makes this very intriguing. So if you have any other questions, I'll hang around. If not, I appreciate you hanging in here with me. And as always, thank you to Allie and Andrew for putting up with me also. Thank you.
Brilliant. Dan, as ever, thank you very much. I just want to put up your, there we go. You can reach Dan at SheridanMentoring.com. It's down there on the front page there. If you have additional questions. Thanks for a great audience participation. I love the way you do that, Dan, the way you can ask people to type into the box and you have that dialogue with them. And we'll see you again in April.
Yeah, look forward to seeing you guys. folks, I just want to encourage you, work on the craft, paper trade it. Don't let it, if this is something interesting to you, practice it on paper. Just get it in your bloodstream a little bit. And remember, the key to this is discipline and consistency. Have a wonderful day. Thank you.
Thank you very much, Dan. Thanks to the audience too. And don't forget to look out for the recording link in your inbox a couple of hours from now. Thanks, Dan. Thanks, everybody.
Thanks, everybody. See you later. Thanks.
Bye.